Stocks and bonds, Quarter 2 General Management. Let's start with the definition of terms. So the first one is stocks or the equity. It is a share which entitles the holder to fixed dividend, whose payment takes priority over that of a common stock dividends. Another definition of stock is that it is a stake of ownership in a company that is sold off in exchange for cash. The next term is the market value. The market value is the amount for which something can be sold in a given market. Another definition is market value is the current price of a stock at which it can be sold. Next is the investor. Investor is a person or organization that puts money into financial plans, property, etc., with the expectation of achieving a profit. A person or institution who invests the money or make the funds available. That is the second definition of investor. Next is the debtor or borrower. A person or institution who owes the money or avails of the fund from the lender. And then next is the principal. The principal is the amount of money borrowed or invested on the origin date. Next, we have this interest. Interest is the amount paid or earned for the use of money. Next is the stock market. Stock market is an equity market where regular activities of buying, selling, and issuance of shares of publicly held companies takes place. Next is the dividend. A dividend is a sum of money paid by a company to its shareholders out of its profits. Next is the stockbroker, an investment advisor who executes buy and sell orders for stocks and other security on behalf of clients. Next is the bond. A bond is a debt that the person or entity enters into which the investors that pays the investor interest on that debt. Or bond is also known as the debt or the credit market. Next is the stockholders. Stockholders is a person, a company, or an institution that owns at least one share of a company's stock. Next is the stock certificate. It is a physical piece of paper that represents a shareholder's ownership in a company. Next one is the commission. Commission is the incentive received by the insurance agent or salesperson who or for the sales achieved in a given. The next is the issuer. Issuer, the company, the state or municipality that issues the bond. Next is the coupon. The coupon is the annual interest paid by the issuer to the lender on the bond. Next is the coupon rate. The coupon rate is the annual payout as percentage of the bond's par value. Next, let us discuss with the two basic types of stocks. The two basic types of stocks is the common stock and the preferred stock. The stockholder in common stock have the voting rights. They can vote, wherein in preferred stocks, the stockholders do not have voting rights. Pero, they receive preferences over the common stockholders in dividends and the company's asset if the company goes bankrupt. So that is the difference between the common stock and the preferred stockholders. Next is the two kinds of bonds value. The first one is the par value and the second one is the market value. What is the difference between the two? Par value is that the par value of the bond is the same as its face value. Parehas lang yung par value at saka yung face value. Wherein in market value of a bond is the price at which the bond is being sold. It may be greater than or less than the amount of the par value. So, yung market value mo, yun yung price ng kung saan na ibenta mo yung bond mo. Pwedeng mas mataas or pwedeng mas maliit kaysa sa par value. So, what is this called? What is this so-called premium? The premium is the market value if the market value is greater than the par value. So, nabanggit dito kanina sa market value. The price at which the bond is being sold, it may be greater than. So, if it is greater than the par value, it is called premium. If it is less than, sabi dito, if the market value is less than the par value. So, if it is less than the par value, the market value is, this is called the discount. We have the listed difference between the stocks and bond on the most fundamental level. So, it is listed here. These are the bases of comparison. This is the stocks and this is the bonds. So, if we are going to compare their definition, the definition of stock is a form of equity instrument or raising money by allowing investors to be part owners of the company. Wherein in bonds, it is a form of debt instrument or raising of money by borrowing from the investor. Dito, nag-i-invest ka, raising money. Dito, nagbaborrow ka pag bond. Next, issuers. Issuers in stocks are corporates, wherein in bonds, it is a government institution, financial institution, or a company, or etc. Next is a status of holders. Status of holders in stocks. Shareholders are the owners of the company. Once you are considered as a shareholder, you are also the owner, one of the owner of the company. Wherein in bonds, bondholder are the lender to the company. Okay? So this one, in shareholders, you are may-ari, owner, isa ka sa may-ari ng company, wherein kapag ikaw naman ay bonds, ang bondholder, ikaw ay isa sa mga lender sa company. Next is form of returns. In stocks, profits earned by the company are paid in the form of dividends, wherein in bonds, interest payment are made in the form of coupon payments. Okay? Next is risk level. The risk level is high in stocks since it depends upon the performance of the issuer, so no guaranteed returns. Wherein in bonds, the risk level is relatively low since bondholders are prioritized for repayments. Okay, so next. So we have this major risk associated. In stocks, we have this market risk and business risk. In bonds, we have this interest rate risk and inflation risk. Okay? So, dito ay yung mga tungkol sa businesses ang associated na risk, wherein dito, yung mga interest na papasok ang at risk. Next is additional benefit. In stocks, the additional benefit is shareholders get the right to vote, wherein in bonds, bondholders get the preference in terms of repayment and on liquidation. And lastly, the market value. The market value in stocks is when the interest rate falls significantly, the market stock rises. In bonds, when market interest rates decreases, the market value of an existing bond increases. So that are the listed the difference between the stocks and bonds from some fundamental level. Okay, so I hope you take time to read and analyze the definitions given in stocks and bond. That is all for today, and thank you.